Good morning and welcome to the Saxo Bank Morning Call. This is Friday, November 30th, and it's the day after another bit of information from the Fed, the FOMC minutes. I felt on Thursday, I think I indicated yesterday, that the market was a little bit overinterpreting the Fed's Powell's comments on where he sees the rate versus the neutral rate. But still, his speech and these minutes giving the overall impression that the Fed is shifting more into neutral and more into a data-dependent mode. I think that is the clear message. Almost zero market reaction. We have this big G20 meeting coming up, but we have to think about why the Fed is doing this. I think it's a little bit of it's a number of factors. I think first of all, the inflationary pressures have failed to materialize to a bit, and we do see the risk of the Phillips curve materializing at some point if we look at wages. However, we can see a clear tightening of financial conditions, and I'll say that's one of the focus points you have here. Is we're seeing quite a big spread widening in these lower quality corporate debt instruments.
Yes, absolutely, John. As you said, you commented actually on Powell, but I believe that what has been most interesting in this week has been the FOMC minutes. The FOMC minutes basically said that they are very worried about the degree of leverage and the amount of high-yield debt that there is in the system. As you can see here, we have a graph that shows U.S. Treasury yields, the 10 years maturities.
That's the black line, and then the blue line is your...
And the blue line is U.S. junk bonds spreads. As you can see, one can basically argue that high-yield spreads has been widening because they've been pushed up by U.S. yields, but then in substance you can see from the graph that U.S. Treasury yields have been rising 50 basis points since the beginning of the year, while instead high-yield spreads have been rising 200 basis points. So basically this obviously shows that there is a deeper reason behind, and the deeper reason is that there is obviously a degradation of debt.
And if we look at where the U.S. yields are, we've sort of priced out the 2019 rate hikes, save for one hike. So we're getting a December hike. That's pretty much a given. And we have about one priced in. That's about the lowest it's been for a number of months since back in the summer. And I have here the 10-year yield, I think, is a very key focus point for the market. And the 3% level where I've drawn that out in red. I think any drop below this yield level, I think you're starting to see a market that is going into risk off mode and safe haven seeking, not necessarily good news for risk assets. And I think that's the key here. Do we see this apparently less hawkish Fed as a reason to celebrate on the risk appetite front? That has been the immediate reaction, Peter, to celebrate the fact that the Fed seems to be decelerating a bit.
Yeah.
Or do we see Fed, a less hawkish Fed as a reason, the reason behind them being less hawkish as because something's going wrong with the economy or the outlook?
Yeah, exactly. That is the interpretation, right? That they will stall rate hikes if the economy is sort of too weakened. But my spin on this is a little bit more that I think actually that the Fed for once is putting more attention to what's going on in the financial market, the credit market, whereas you all remember Ben Bernanke back in 2007, the US economy is okay, it's slowing, but it's still okay, which was terribly wrong because all economic data is lacking and mirror looking, right? So
yeah.
You have to use financial market in your guidance.
That was also the focus of Powell's speech. He listed all the different financial stability parameters, saying there's not big causes for concerns, exactly. But that is definitely his focus.
But also, I had this chart. Maybe if you can bring it up, John. I mean, it's on the inflation. There's been a lot of talk about inside the Fed's, the Fed camp about how you do inflation targeting, and this I've used it before in my presentations for Saxo clients. And what you do is that if you have a target, you should be allowed to go above that target. So what you should do is you should anchor some price point. I just did it here in 1995, and the light blue line is basically a 2% growth in PCE core price level, and then you have the dark line here is actually the realized inflation, and you can actually see the gap here is widening. So I would say this is just a small evidence that you could actually argue for why you should have rates being very accommodative still.
And if you base that, you can sell from the slope of the curve a little bit. If you base that in 2010, it would have been an even bigger gap between the target and the tendency since then. Okay, enough about the Fed, at least for the moment. I think the big elephant in the room, we've been talking about it for far too long now, is this G20 meeting, and we still have this huge question looming about the U.S. and Chinese trade relationship. Our pretty firm, I think, consensus here is that we're not going to see anything that resembles much more than lipstick on a pig, which is the relationship between Trump and China. This is a source of endless populist support for Trump. The only reason I think he might concede to something in the near term might be to keep the stock market elevated. But now that he's got the stock market going for him and the wind at his back there, and the Fed having stepped back a little bit as well, maybe less need or less urgency on Trump's part for striking any kind of what looks like an accommodative stance. And of course, the big question for my market, FX, is the dollar CNY. I've got a chart here of the dollar CNH, which is the offshore flavor of the Chinese yuan. Nothing going on. We're all holding our breath. We're all wondering what's going to go on next. And there is tremendous pressure for this currency to devalue beyond 7. Will the G20 summit be a trigger? My guess would be not immediately so, unless some sort of agreement to allow a devaluation has taken place. And if not, then we have a nervous waiting period until China makes a move on its currency. So that's my impression there. As well, you have a.
But what do you think about the Fed's new trajectory potentially? I mean, the impact on the dollar, because if the dollar is not going to strengthen further from here, I mean, obviously you should ease the concerns a little bit on the Chinese devaluation, I guess. I
think there are two elements, and I actually have a slide on that later. Let's see if I can pull it up here. I think U.S. yields, and risk appetite are the two factors. So if U.S. yields are sort of flat to slightly lower, and risk appetite is strong.
Yeah.
Then yes, so then I see the dollar pressure, to rise against the Chinese currency far lower, and both currencies might sort of fall a bit together. However, if we have low yields because the world is concerned about the trajectory of global growth, and we have risk off, then I think that's a more dollar supportive environment. And also, if we have an ugly outcome to the G20, I think that will tend to be more dollar supportive. Yeah. That's the way that the market's been trading it. So to get back to where I was. Actually, briefly on G20, there is a tremendous pressure on China here from an economic standpoint in their attempts to deleverage. And you have a chart here, Peter, on their credit transmission.
Exactly, and I actually used this in my brief equity comment yesterday on Home.Saxo, and I wanted to play the devil's advocate here, because we all know Steen's thoughts on China. I have also been talking about this potential China re-engineering of growth in Q1 with all the stimulus coming through. But I play the devil's advocate here and say, I think maybe potentially what China is facing is a credit transmission that is broken, something like what we have seen in Europe for many years. And yes, you can see the two comments down there. The China Beige Book is a comment from 2014. That was the first time the credit transmission broken was first talked about. And lately, I think Reuters had an article 2 weeks ago that actually Chinese small companies have very difficulty getting credit. What you see on the charts very quickly is that to the left, it's the market value of the total assets of Chinese banks. And you can see that it's just been going down and down and flatline. JP Morgan is to the right. It's this, the JP Morgan profile is what you see in all US banks, and it fits the hypothesis that if you have an improved credit condition, you put a higher market value of those loans and assets because you have a brighter outlook. And when the market in China is not putting a higher market value on all this new extension of loans and credit, I think it's the markets saying that we don't really trust the creditworthiness of all this credit in China, and that's why I think it's broken.
Also, the shutting down of this shadow lending and peer-to-peer lending, all these networks, means the whole credit pie is having a hard time growing in the way it used to.
And it's a big problem for a government like China, right? Because how do you engineer growth if there is no credit transmission? You can't use a banking system, so you probably you have to do more on the fiscal side, which comes with clear risk, of course.
Perhaps a weaker currency now that you're at a current account, going into a current account deficit. Just to round off the G20 discussion, Peter, and your one slide here on we have a pretty solid bounce here in equities.
This is the NASDAQ 100, and as you just said, we have had four or five sessions now with some pretty solid sentiment rising. I just put in there was 4 earnings releases from some of the more secondary tech stocks, but very much with rich valuations. So VMware, Workday, Splunk, and Palo Alto, they all beat expectations. Very strong outlook. So my point is that the Fed has now delivered. We had some very strong tech earnings that's bolstering sentiment. But and we're pushing towards that higher end of, or sort of high,
resistance.
Resistance levels. They have that falling trend line there. If we get just the slightest positive spin on the G20, I think we could take off in the Nasdaq. But I think the G20 is
into the year end. Is that sufficient for that, or would you not?
That depends on what we get over the weekend. Yeah. But as you know, I don't think we'll get a strong deal.
And in terms of liftoff, I think the euro very much having a hard time achieving liftoff. The growth number is coming in increasingly weakly. The inflation is not really showing signs of being a threat, especially now the big collapse in oil prices. And then we have as well, we talked earlier about, I'll tell you about the whole credit spread situation in the U.S. You're seeing junk spread widening in Europe as well. I mean,
exactly.
ECB's pulling out after the end of this year anyway, right?
Well, that's what basically they have been saying, but there is a feeling that the ECB might be starting to hike not after next summer, but actually after next Christmas. So we are talking about 2020. We have a graph here that shows exactly what we have seen also in the US. In black we have the 10 years Bund yields, and instead in green we have European high yield corporate spreads. And the interesting thing is that while the ECB monetary policy have been accommodative, and then the Bunds have been falling since the beginning of the year until today, junk spreads have been widening anyway. And many people could say that this has been due to the widening of Italian corporate spreads. But then if you open up the European arena, you will see that behind the Italian headlines, there has been more rumors regarding junk bonds, and there has been an increase of deals compared to last year that have not been able to price. So companies like TUI, Bilfinger, Aldesa, companies that are not Italian, have not been able to place debt in the primary market. So I believe that this is a reason to concern, and the thing that actually concerns me the most is that if the ECB doesn't hike at the end of next year and hikes in 2020, they are basically lacking of any tool to stimulate the economy at this point.
That's a long time frame when you have these parliamentary elections coming up in May, and then next year another cycle of this Italian budget, which I think where I think the debate could get even more vociferous than this time around. Let's round off the debate or the talk today with the economic calendar. We filled in a new week for next week on this one today. Of course, we have the G20 getting underway today. There could be some kind of draft communique circulated today, and then the actual meeting between Trump and Xi takes place on Saturday. So we may be in for a chaotic opening if something particularly dramatic unfolds in the wake of statements in the wake of that meeting. Canadian GDP is the main data point I would sort of highlight on today's calendar. And then next week, I don't want to talk through all of this, but it's the big manufacturing PMI day on Monday, and then the services PMI day on Wednesday. Both the private Caixin PMIs on Monday and Wednesday, and then the US ISM and ISM non-manufacturing. Two central bank meetings, Australian RBA, they're expected to do nothing, and then the Bank of Canada on Wednesday. Finally, Friday, the average hourly earnings will be the key focus there, with a new high for the cycle expected. I think 3.2% year on year is the expected number there. That would be a new high. And, we'll bring back some talk of the Phillips curve swinging into action. Finally, on my calendar, the one thing I have put in here, I think is going to take up increasing bandwidth at least in the political headlines, perhaps not so much in the financial headlines, although it could impact Trump's policy to some degree at some point. The Mueller investigation appears to be wrapping up its investigation portion of what it's doing, and now is going after individuals and could be releasing things to Congress in the coming days and weeks. And I think this is going to occupy a lot of Trump's attention. So keep that in mind as a sort of left field risk here. That's it for today. Have a great weekend, and we'll be back next week with the Saxo Bank Morning Call.